Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Shailesh Kumar, who has an MBA from the University of Michigan. He's a former management consultant and entrepreneur with multiple exits. With 25 plus years perfecting small cap value investing, he brings exclusive high growth strategies for building wealth. We've got a lot to talk about today. Shailesh, welcome to the Contrarian Capitalist podcast.
Thank you, Robert. I'm so glad to be on the podcast. I think I'm looking forward to this chat. Let's start.
Yes. Yeah, likewise. There's a lot to talk about, and we were just saying off air that the work that you do, number one, is fantastic because you are really digging into a multitude of companies and you help a lot of people as well, which is obviously very, very good. But if we can, before we go into the weeds, a little bit more about your background in general, if you can.
Oh, absolutely. Like you mentioned, I completed my MBA from University of Michigan, and I have worked in management consulting. I have uh, worked with top executives like CEO level. And during that time, I've had the opportunity to actually look at how businesses run, how they work. Uh, and also, most of the time, these are large companies. So right now, I focus on small cap, but some of the problems are pretty much the same. I mean, you have cash flow issues, right? Every company has to go through that. Uh, and then you have projects that you're working on within a company where you need a certain return on investment. So that experience actually did teach me a lot about what's going on in managing and running successful companies. And then I also got to learn the problems that may come up. And because as a management consultants, we were called upon to solve those problems.
Hmm.
Uh, In that period, when I was a management consultant, we actually spun out a small division from the consulting firm that I was working for. And this was kind of a spin-off company, and I worked for a couple of years as a CFO. So I've had a front row seat
Mhm.
uh, looking at the finances of the companies. And I think that gives me a kind of a unique point of view when I start analyzing businesses because I'm not just doing a theoretical analysis. I am bringing up my experience and using that as part of my analysis. Uh, so that's my perspective when I start analyzing companies. Uh, Subsequent to my management consulting career, like you mentioned, that I have had a few exits, uh, and these were mostly manufacturing companies. So this is not high tech. It's actually, boots on the factory floor kind of stuff.
Mhm.
So uh, I bought a couple of companies. I ran them for a few years, and then I exited. Uh, so I live in Ann Arbor, Michigan, which is pretty much a suburb of Detroit.
Mhm.
And as you know, Detroit is a very solidly automotive oriented economy. And so when I talk about manufacturing companies, we were suppliers to automotive firms, for example. Uh, So yeah, I mean, it has been fun to look at, how the value chain works within different industries, how the finances work, and I bring all that experience into my research.
If for anyone not familiar with Detroit, Ford is probably going to be the company that people would most associate with the city of Detroit. Just as an FYI, Shailesh, I think that's all of that's fascinating because I know that, and what I will say is, if we mention any companies or we're speaking about everything today, we're not financial, advisors. So please don't take any of these as recommendations.
Mhm. Absolutely.
So when you look at, I want to try and get in your processes, your ways of looking at companies. So how would you how would you start that process? Would you get a something that you might find online, or maybe someone in your peer group that recommends you have a look at a company? What does your process look like, and how do you do it?
So typically, when you research stocks, you can go about it two different ways. You can do top down, where you're looking at, okay, so I know this particular industry is kind of distressed right now, and I want to dig deeper into the industry to see what opportunities may exist. So that's one way of doing it. The second way of doing it is, which is pretty much what I do normally, is to do a bottoms up approach,
Mhm.
where I'm looking at my universe of 9,000 different stocks in the US. Okay. And then I filter them down based on certain criteria I have. And I have like so we call it a screening for the stocks, right? And so I have different screens that I have personally built.
Mhm.
And each screen has its own set of criteria. And so, for example, you can have a very simple screen saying, oh, I want stocks that have the price to earnings ratio below 15, for example, right?
Yeah.
That's a very simple screen. Of course, you can make it more complicated. You can look at my free cash flow yield should be this much, et cetera, et cetera. You can add a lot of filters. So I start with the screening process, and this is my bottoms up approach. So I run different screens throughout the month. And each time I run a screen, I get a short list of, 5 to 50 stocks, depending on how many fit the criteria. And from there on, it's just a matter of, scanning through the stocks, looking at their financials. And normally I don't do a very deep dive at this point. I
Mhm.
just quickly scan through them and see what may be interesting to me. And then I may find one or two stocks that I want to go deeper into. And so at that point, I say, okay, let's start focusing on these stocks. And then I start pulling up the annual reports, the quarterly filings, etc., and just trying to understand what the company does and how the business is structured. And once I understand the company, then I can sit down and start doing the valuation work on the company. So it's one thing to find a good company, and if you buy a good company and you stay with it for a while, uh, you will eventually, do well. What I want to do is to not only find a good company, but I also don't want to pay a lot
Mhm.
for the stock. So I want to buy the stock at a good price, at an attractive price, because, I mean, there are a lot of good companies that are available to you. It's not like we are lacking in opportunities. So I want to be a little bit more selective and pay less than I should. The benefit of doing that is twofold. For example, if you buy a stock at let's say 30% discount, okay. And when I say discount, then you have the concept of intrinsic value, right? Because there's a discount to something, and that's the fair value or the intrinsic value. So if you buy a stock at 30% discount, for example, that actually gives you a 30% margin of safety,
Mhm.
right? So because we are not paying the full price, if the economy goes down tomorrow, the stock should actually be less affected than the rest of the market. And the reason is that the stock price is already depressed. We are not overpaying for the stock. So there is less room for it to go down. It has already taken its hits, I guess. So that's the margin of safety that kind of makes the stocks a little bit more resilient for me,
Mhm.
reduces the risk. And when we talk about risk, it's mostly risk of loss. And it also gives you an indication of what you expect in terms of profits if the stock were to be repriced to its fair value, right?
Mhm.
So that's my main process. It's like doing the same thing every day, screening, reading the reports, trying to build a thesis. Uh, but I find it very rewarding.
No, absolutely. I've read through quite a few of your articles where you've deep dived into certain companies, and I found them very insightful. And
Mhm.
what I will
Thank
say
you.
is that we might, if I reference articles in this, so if you're watching this on YouTube or you listen to the podcast, if I'm referencing articles, what I'll do is on the post that comes with the Substack, so it's contrariancapitalist.substack.com, I'll link to all of these posts that we're talking about just so it's easy for you, the listener, to go and find them. Shailesh, do you have any? So appreciate you've gone through your process. So it's a lot of screening, a lot of filtering.
Mhm.
Is it important for not just yourself, but for every investor out there? Is it important that they understand the company and the industry in which they're operating, or are you just mainly looking at the numbers? Do you find it important to understand that company?
I Yeah, so if you look at the history of value investing, it was pretty much started by this chap called Benjamin Graham. And Graham actually did not believe in talking to the management, did not believe in doing a lot of, understanding the business part. He worked mainly based on the data that was in front of him, right? Warren Buffett, on the other hand, uh, actually spends a lot of time trying to get much deeper into the company, the actual business of the company, because he really wants to understand everything
Hmm.
uh, necessary, uh, right? I am actually more on the Buffett side. So I do look at the numbers, and that's very important to me. But I also want to understand the company, and I'll tell you the reason why. And I think this is something that every value investor should think about. I mainly invest in small cap stocks, okay? Undervalued small cap stocks. There are two things that you have to be aware of and also be very careful about when you invest in small caps. One, they tend to be very volatile. The main reason is it's a small company that really don't have too many shares outstanding. So every time somebody buys or sell, it moves the price, right? If you don't understand the business, and if the price fell 10% tomorrow and you have uh, and there's no obvious reason why it happened, if you don't understand the business, you're likely to panic, right? But if you do understand the business, then you're able to mentally separate, the market price movements from the actual business performance and say, okay, these are not related. This is just the market doing what it's doing, right? And if you have a good understanding, then you may actually take that opportunity to increase your holding, right? So you can see it's like two totally different reactions to the same price decline. One of them makes you a lot of money, and the other one actually you may end up losing money.
Hmm.
So I think it's very important for all value investors, especially if you are investing in small cap stocks, to really understand the business. Now, the second point I wanted to mention is that for small cap stocks, actually understanding the business is not hard because most of the times you are looking at one product or a few product but of the same type, uh, and the business is very simple to understand, right? You're not looking at Pfizer, for example, that have like 10 different, or I don't know how many, 20 different uh, drugs in the market, right? And
Hmm.
then one of them is going out of the patent, and the other two are just launching, and there's like uh, you know, uh, a lot of things going on at the same time. There are a lot of moving parts. So It's really hard to balance. But if you own a company, like for example, we own this company called Miller Enterprises, uh, it makes towing equipment, right?
Mhm.
It's only one product. It makes towing equipment. Of course, there are multiple different models of the equipment, and they have like some models are built for the military, for example. So, there are variations in the product line, but it is one product line if you look at it, right? They do
Mhm.
one thing. They make towing equipment, and so I mean that kind of business model is easier to understand, and so there's no reason why you would not uh, spend some time to understand what's going on.
Now, thanks for that explanation. That makes things a lot easier. So I like the way that you've broken that down, the bigger companies and the small cap, and you've basically said that
Mm.
for yourself, you obviously the numbers are important anyway. So I think that's fair to say, we all understand that. And then for yourself in particular, it's a case of you like to know a bit about the company and what's going on. And I think that example is absolutely fantastic. People are always going to want to tow something, whether it's a caravan, a
Mhm.
trailer, farming equipment, whatever it is. And then it's a case
Right.
of getting into that. I think that's a really good example. Thank you.
Absolutely.
In terms of risk management,
Yep.
how do you like to manage risk? There's so many different ways to do it, but what are your principles when it comes to risk management?
Huh. So this can get a little bit more technical. I do take managing risk is a very important part of what I do. And over the years, I have uh, evolved in how I do it. So when I started out, I had very strict rules about what I can and what I cannot do. For example, I would buy only one stock in any given industry or sector, right? So that kind of limits me to just going after the best stock in that sector. But what it also does is that if I have five stocks, it forces me to have five stocks in different sectors, and that kind of forces me to diversify my portfolio, right? So that's one. And the second, I had a limit on how much of the portfolio can be allocated to any given stock. And I typically used to do 10% or lower. So I would not go above 10%. And that actually worked very well. But so here's the thing about managing risk. You need to have a process. It doesn't really matter what kind of process you have. You need to have a process, right? Because once you have a process, and it can be a very simple process, over time you tweak it based on how things are working out. So over time you will improve that process, right? Uh, a lot of investors actually don't have any process.
Mhm.
They would just buy a stock and they'll be like, okay, I have so much money available, let me put in this much. But there is no thinking behind it on why I should allocate so much to this particular position. And why should I buy Lowe's when I already own Home Depot? Because,
Mm.
it's the same industry. It's pretty much the same exposure, right, to the market risk. So, you know, over time you evolve. Now I do something which is a little bit more sophisticated. So I actually go back 3 years and I try to figure out the correlations between the different positions I have.
Mhm.
And I try to minimize the correlations. So my portfolio is pretty much optimized to minimize the correlations between positions in the portfolio. And so I'm not winging it. I'm not saying that, hey, I'll buy a stock in a different industry to get diversification. I'll actually look at the data
Hmm.
to see what the correlation is and then use that data to figure out how much to allocate. And so I have like a whole spreadsheet built up to do this modeling work for me. But what it has also done is that it has allowed me to uh, own a larger, I can allocate more to one stock if I feel
Hmm.
it necessary.
Yeah.
So I'm not limited to 10% anymore.
Hmm.
So I have right now, I think there's one stock which I'm up to 25% of my portfolio in that stock. And I can now do this because, and by the way, that's working out really well right now. Uh, I can do this because I have taken the steps to minimize the correlations between this stock and everything else in the portfolio. So I'm managing my risk. I'm not eliminating risk completely, but I'm managing the risk.
Hmm.
Uh, on the risk elimination part, there's this mathematical model called Kelly criterion, which actually it comes from gambling. So uh, it's it's the optimal bet you can place, optimal money you can bet on a single bet
Hmm.
to eliminate the risk of losing it all, I guess. You won't go broke if you so there's if you bet too little, then it doesn't make a difference. It doesn't make much of a difference even if you win big, right?
Hmm.
But if you bet too much, then your risk of going broke is really high.
Yeah.
So, so there is an optimal level of betting which maximizes your future profits and minimizes your risk of going broke. Okay. Now, I'm a little bit careful here because when I say risk, it means risk of losing money.
Hmm.
Uh, in finance nowadays, when people talk about risk, they talk about volatility. All right. I'm not worried about volatility. I'm worried about the risk of losing money.
Hmm.
And so I use this Kelly criteria, and I have this model built up that looks at correlations between each position and finds me the allocations that maximizes the returns and minimize the risk.
I like how the process has evolved over time, and it sounds like you've
Mhm.
become even more sophisticated with that process. And I also like what you said at the start about every investor needs to have some form of process so they know what they're doing.
Right.
On the other side of that, and it might sound like the same question, but I often find that in life, whether it's small cap investing or writing down life goals, people sometimes don't normally have an exit plan. So we've
Mhm.
just spoken about risk management. Do you also then have a particular exit plan for your stocks, i.e., a certain profit level or percentage? How do you deal with that aspect of small cap investing?
Right. So we talk about margin of safety, and that involves the process of figuring out the intrinsic value or the fair value of the stock, right? So the fair value is where I would actually consider taking profit,
Okay.
right? So that's one threshold or one trigger for taking profit. But the risk management plan that I discussed, it calculates the allocation. And one
Hmm.
input to this model is the expected profit from the current price, right? So if the stock price goes up, for example, the expected future profit goes down because we are getting closer to the intrinsic value,
Hmm.
right? And so the model actually works to reduce the allocation to this stock because now my expected profit is lower,
Yeah.
right? Similarly, if the stock price goes down, and this is a normal, I mean, there's nothing change in the business, it's just a normal market volatility, then my expected returns would actually go up because now we are further away from the intrinsic value. And so the model will allocate more to the stock. So what I do normally is that I recalculate the allocations every month,
Hmm.
once a month, and it gives me new allocations based on how the prices have moved. And also, if there's some new information and that changes the expected return value, I can bring it in at that time. And so the model itself may actually kick me out of a position saying, okay, you allocate zero or you allocate a negative percentage, which is pretty much asking me to short the stock, but I don't short.
Hmm.
I only do long. So then I would kick out that position and then redo the portfolio. So yeah, this model works very well for me, and it helps me uh, stay disciplined uh, to the process. Yeah.
And I guess that's why it's obviously there's a lot of news out there. There's always a lot of news out
Mhm.
there, especially in the last couple of months. There's been a lot of people tweeting things, and then we've seen the market go, up, down, left, right, and all directions. So I think the lesson to take away from this is that if you have a model or you have a set of rules, like clearly you
Mhm.
do, model, spreadsheet, and so forth, if you understand the company and the numbers are good, and you know what this company does, then by using a model and using a process, then that obviously that does not guarantee success, but it certainly helps the probability of success. It's higher than if you were just picking a number out of thin air uh,
Right,
and
right.
being random.
Right. I mean, you need to have a goal so that you need to have a destination so that you can stay on the path. Right. Uh, I think just to add to that, there's another thing that's involved in here, which is like you need to have a faith in the process, right?
Mhm.
So, I mean, I take it as a gospel that value investing works. And in my experience, and I have a lot of experience going back a lot of years, it has worked, right? Uh, but I understand a lot of people are not sold on value investing, and many people like to chase growth because it's immediate and it's very visible, right?
Mhm.
Uh, it's hard to buy a small unknown company and stay with it when you know that your friend is, making a lot of money on Nvidia, for example, right?
Mhm.
Uh, so, you need to have faith in the process. The model is good, but if you don't have faith in the process, the model is useless to you. So, I stick with the model because I know it works and I have experience telling me that it works. But for somebody just starting out, you just have to believe in the beginning.
I think that's great advice, and that also brings me to an article that you wrote on your website. And again, I'll link to this in the show notes. So I just want to read out the first paragraph because I think it's incredibly
Mhm.
important. And I quote, "Let's start with a reality check. A company can be fundamentally sound and still see its stock cut in half. Why? Because markets are driven not just by cash flows and earnings, but by fear, liquidity, sentiment, and external forces beyond any investor's control. Tariffs can crush margins, wars can upend supply chains, currency rises can make earnings forecasts obsolete overnight."
Mhm.
That's incredibly fundamental because there's obviously so much going on. And the point of
Right.
reading that out is to show that it's important to understand at least a bit about the company and again a process, no matter what your process is, because then that way, if you know the longer term gain or outlook, like I would do in for example, some of my stocks, or most of my stocks are uranium and gold and silver miners,
Hmm.
because my long-term thesis, for want of a better way of putting it, is that the gold and silver price, etc., are going to go much higher because of A, B, and C. That doesn't mean every company is
Hmm.
great, but it is what it is.
Right.
But I love that paragraph because it brings reality to the conversation that there's a lot of news, a lot of things can happen. This is why you need to have a model, an exit plan, and to be able to manage risk effectively.
Absolutely. And that's where the faith comes in as well. I think Warren Buffett once said that, if the market shuts down for next 10 years, I'll be fine. I don't need to see the market go up and down every single day. I know what I own and I'm confident in what I own. And, we invest in businesses. We are not buying pieces of paper. We are buying shares in companies. And that's the kind of mindset you need to bring to investing.
Shailesh, just on another article that you've written, and I appreciate this is only a part one, so you can go into this
Mhm.
in as much or as little detail as you want, but you've obviously been doing a lot of research and you might have potentially found, dare I say, the next Berkshire Hathaway. You wrote a really good
Right.
article on this. Again, I'll link to it. What is this company? What's your research telling you? Go into as much detail as you want.
Yeah, I would not want to disclose the company right away, right now. I'm still two reasons. First, I want to keep it to the paid subscribers, but the second is I'm still in the process of completing my research, and so I have started. This is why I broke it out into multiple parts, and so far I'm like fairly confident, like 60 to 70%. Yes, this is a good investment. Uh, but like the point we talked about earlier, a quality company is not the same as buying it at an attractive price, right? So I know the company is quality. I know it's a good long-term hold. I just want to make sure that we are not going to overpay at the current prices, and that part I have not completed yet. Uh, but I'll give you a little bit information about the company. The company is actually a very old company. It's over 100-year-old company, but it has changed quite a bit since it was started.
Mhm.
Uh, quite involved in this company, and he was on the board for about 40 years on this company. So he knows this company relatively, very intimately. Uh, he actually owned the company, a large number of shares as well. But the company has changed. I think the Buffett is not on the board anymore, and he also exited his position in the company. Uh, the company is family run,
Mhm.
and they have very solid management team who is long-term oriented, and they look after the shareholders, and they're trying to grow the business using the same playbook as Berkshire Hathaway. So they're buying businesses at cheap prices,
Mhm.
and then they're giving them the uh, flexibility to run the businesses. The old management stays behind and they continue to run the businesses and create the value. So they are pretty much running a portfolio of businesses. Most of them are fully owned by the company. And also, similar to Buffett, this company does not believe in giving quarterly guidance, for example.
Mhm.
So there's no guidance. I mean, they don't run their business quarter to quarter to satisfy the Wall Street. They run the business for the long term benefit
Mhm.
of the shareholders. I guess that's all I can say at this point. But yeah, if you link to the article, people can read that, and then I'll have the part two and maybe possibly part three coming out sometime this week as well. So they will certainly have the full access at some point.
Absolutely. I'll link to the article as mentioned. That's
Mhm.
not a problem. Shailesh, I'm just thinking that we've spoken about risk management, we've spoken about potential exit strategies, we've touched upon a company that you are doing some deep dive research into at the moment.
Mhm.
Are there any other general rules or bits of advice or any information that we haven't yet spoken about that you think would be very valuable to the listener?
Uh, yeah, I think in investing, especially if you're like a value investor or if you're investing for fundamentals, uh, patience is a very important attribute to have. And I mean, I'm talking about patience on many different levels. For example, of course, you have a thesis and you are waiting for the thesis to play out, right? It may
Mhm.
happen tomorrow or it may take 2 years. So when you invest, you have to build that uncertainty into your model, and then you have to be willing to wait for things to work out. So that's one. But the second, and I see this very often, because I buy small cap value stocks, and a lot of these stocks are not very liquid, right? So if you go out to your broker and say, hey, buy me 100 shares of this company, and I want to do a market order, right? If the stock price is $10 right now, your order may actually fill at 12, right? Because it's not a very liquid market in this stock. And some of the companies only have 10,000, 15,000 uh, share volume per day.
Mm.
So, you have to be patient. I mean, these kind of investments, you need to be able to say, hey, I want to buy a certain number of shares. I don't need to have them right now. I'll let the order, I'll keep it open for, a week or 2 weeks or something and just let it fill as it does, right? The market makers will get you the shares that you want at the price you want, but you have to let them to do their job. I think once you understand all this and you get into the flow of how the small cap investing works, um, you'll realize it's very different than, buying Coca-Cola or buying Microsoft, which is like, you place an order and you within a second you get all your shares. So yeah, to your question, yeah, patience is kind of a very important attribute to have, and you cannot be flustered by things not going your way right away.
Which I think all links into knowing what the process is, what the exit strategy is, and how to manage that risk in
Right.
general, and also how to manage your emotions is probably another very important thing to manage as well.
Absolutely. Absolutely. I always say that, for any investment, the price you pay in the beginning is the most important part. Because if you make sure you get a good price, you'll be okay in the long run. Uh, the other thing I say, and it may come out a little bit flippant, but you know, in investing, if you can just cut out the downside, then all you have left is the upside, right?
Mhm.
So the point I'm trying to make is that risk management is a very important part of your process. If you ignore it or if you don't have a process, you will lose money. And this is a very simple thing to do. Like we said, you just have to have a process, right? Any process, just have a process, and then you can tweak it as things evolve. But have a process, and once you have a process, and you even if you cut down your downside by half, your upside is gone up like a 30% or something.
I think there's a lot of important information there, and I'm hoping that people have got a lot of value from the lessons and the information that you've handed over today. So, thank you very much for doing that. I always like to give people the opportunity to say, where they can be found. So, how can people find yourself? How can people connect with you, Shailesh?
Yes, Robert will have some links on the podcast. You can find me on Substack. I write the newsletter called Astute Investors Calculus, and the Substack address is ASTUTEINVESTOR.substack.com. I have also recently started a Twitter account, and you can find me on Twitter or X at Invest Astutely. INVESTASTUTELY. That's my Twitter handle. So yeah, just come say hi, connect with me, and I'm always open for any chats or DMs or discussions. Just let me know.
Fantastic. And as usual, all of those links will be in the description or show notes that come with the podcast. What I would say is if you're going to take one lesson and one lesson only from today, it would be, as Shailesh has said so many times, have a process. Doesn't matter what that process is, but have that process. Uh, Shailesh, I've learned a lot. Thank you so much for your time. It's been really, really enjoyable. Look forward to speaking again in the future.
Absolutely, Robert. It has been a pleasure. Thank you.